Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. My guest today is David Schassler. He's Van Eck's head of multi-asset solutions, and we're going to be talking about inflation. This is a topic that he's been talking a lot about over the last couple of years. And there have been recent changes with Fed policy, and it's something that we wanted to revisit in this quickie episode. David, hey, thanks for joining the podcast.
Ed, thanks for inviting me.
Is this the first time you're on?
I was thinking about that. You've been doing these podcasts for years. We sit near each other. You never invited me on. I was starting to get offended, but finally you invited me on, so we're all good now. Yeah,
well, I had to make sure I was good enough to give you a good platform. And we're going on, 3 or 4 years, so it's about time. But yeah, thanks again for coming on. And, I think what we'd like to do is just kind of narrow in on this topic of inflation a little bit and kind of get your perspective of where we are in the market in terms of inflation. And maybe one way I'll set that up is, in September, we're recording now, say almost mid-October 2024, September of 24, the Fed cut interest rates 50 basis points. Inflation has been on the way down. Did we conquer inflation? Is the inflation worry over?
Yeah, so I think that people should stop really far short of saying inflation was conquered. Maybe let's jump back a little bit in time. Shortly after COVID, we were one of the few voices jumping up and down screaming, saying that we thought that we were going to be in a period of extreme inflation, right? We weren't talking about a little bit of inflation. We were talking about a lot of inflation, and we said it was going to last a really long time. Now, our view is kind of similar, right? In regards to, we thought we were going to get a pocket of inflation. And when you look at periods of historical inflation, you get a pocket of inflation, pocket of disinflation, pocket of inflation, pocket of disinflation throughout the inflation cycle. And you can go back and look at historical inflation cycles and you see that that's a commonality. Another commonality is that inflation periods last a long time. They're really sticky. They're hard to control once you get in one of them. That's why it was so important we didn't end up here. But we did end up here. So now once we're here, what should we expect going forward? We think you're going to average inflation 3 to 5%, pockets of hotter inflation, pockets of more mild inflation. And I think that we are in a near-term low of where inflation is going to be. Fiscally, we're stepping on the gas. From a monetary perspective, we're stepping on the brakes. Now we're easing our foot off the brakes while still stepping on the gas. From a fiscal perspective, expect inflation now to start rising again.
Now, in your first assessment after COVID, what were the facts on the ground? Was it just a supply shock that really propelled inflation, or did you see something even further? Did you look at the fiscal deficit and the debt and all of that as well?
The big debates I was having with people in our industry, they were saying, well, we were talking about a big increase in the money supply, and then they would point to the period leading up to the financial crisis and shortly thereafter where we had a huge increase in money supply, but no inflation. And they would say, well, that's what we're going to get. We're going to get a lot of increase in money supply. We're not getting inflation. You print trillions of dollars, you dig a big hole in your backyard and you put it there. Well, you're not going to get inflation because the money's not going to get out. Alternatively, you print a lot of money, you give it to Americans that need it, and guess what? They're going to spend it. Not a big shock there. It's going to drive prices up because the demand's going to rise more than the supply, and you're going to end up with this imbalance. And that's what we have. And we don't really see that changing for a lot of different reasons. Now, we're not saying we're going to go back to where we were, right? We think that peak inflation is behind us, but we are saying we don't go back down to 2% and stay there. You might go to 2% temporarily. You might even go negative if we get some type of big recession, which we're not saying we're going to have. But if you were to have that, you can go negative and still be in broadly a period of high inflation, an inflationary cycle.
Why do you think inflation was so low for so long prior to COVID? Money supply had been increasing for years, no?
There's always inflationary forces and there's always disinflationary forces. In the United States, we exported our manufacturing to places that could do it a lot more efficiently, a lot cheaper, and we got a lot of cheap goods coming in, and that was great for a long period of time. So we effectively hollowed out our manufacturing base, sent it overseas. We couldn't be competitive anymore in that regards. Bought these cheaper goods, switched over to a service-based economy, and we sowed the benefits of that, where you got lower inflation for an extended period of time, strong economic growth, and here we were, right? But a lot of those things have changed, and now we're sitting here with inflation. And we think it's going to continue to tick back up. And we're going to be there. Again, we're not calling for double-digit inflation, but we are saying that we don't go to 2% and stay there. We don't flatline at 2%.
So reshoring, bringing that manufacturing capability back as one factor in the potential to increase inflation rates or see higher prices going forward?
There was innovation, right? There was a lot of innovation that took its way to come out. And we're actually having innovation now, which we think will actually be deflationary in the long run, because remember what I said, there's always inflationary forces, there's always deflationary forces. Now, the internet came out and made a lot of big promises, sent stock prices up, but we actually weren't there, right? It took years for the internet to actually come out and for Amazon to become the beast that it is and to actually fully yield the benefits of the internet, right? And we got that and everything became more efficient. The lives for billions of people got better and better and better. That's what happens with general purpose technologies, right? General purpose technologies, the internet, the computer, the steam engine, the wheel, right? These are general purpose technologies that drive innovation, drive productivity, eventually drive economic growth, right? So that the internet brought that forward, drove efficiencies, kept prices down. Now, we've got another general purpose technology that we think is going to be equally as impactful as the internet. We're talking about AI, obviously. And we think eventually that's going to drive huge productivity gains, huge economic growth. But the key word there is eventually. It's not going to happen tomorrow. And in the meantime, what's going to happen is we're going to require a lot more energy. If you believe in AI, you believe in that there's going to be a huge increase in the demand for energy. That's obviously going to put upward pressure on energy prices.
And so you've talked about different regimes of inflation, different periods, and then different types of assets that work in those different regimes. I wonder if you could just kind of recap that a little bit and then tell us kind of where we sit today.
The core issue here is financial excess. We've got governments spending a lot of money, running big deficits, especially during periods of time when they historically wouldn't, right? So we're on this situation where we've got huge deficits being funded by big debt, eventually money printing. Now, that's the backdrop. So when you got periods of financial excess, the natural beneficiaries of financial excess are assets with scarcity. The ultimate store of value asset's gold. We've been bullish on gold for a long time. We've been saying that gold is going to be a top performing asset. We think that that's going to continue.
Because of the financial excess or because you're watching what central banks are doing? Because it's mostly been central banks buying gold.
Let's break that down a little bit. We actually just wrote a paper on this. It's on the website. We encourage people to read it. But here's the thing with gold. Gold historically is a top performing asset. It lags equities, which are the top performing of the major assets. And then you've got gold, which have historically generated an 8% annualized return. It's a strong performer. Not only is it an asset that performs well, it's an asset that diversifies your portfolio. So that's the kind of the long-term setup of a unique, uncorrelated asset, which I didn't say, but it is uncorrelated as well. So you've got a unique asset that generates a strong return and outperforms historically when the other ones don't, when the other ones are struggling. So that's the long-term scenario. Now, that gives you your 8% annualized return over time. Now, why do we think it's going to do even better? We think it's going to do even better now because if you look at gold and money supply increasing is the constant devaluation of the US dollar. That's effectively what you're looking at. And as the dollar depreciates, right, the value of gold continues to rise. So there's if you plot, and we do in this paper, the supply of US dollars, so M2, and the price of gold, you see that there's a very, very strong relationship. And we think that the money supply is going to continue to increase to be able to sustain our extreme overspending, huge deficits, big debt. So we think that that's a structural part of where we are because we've effectively passed the debt Rubicon. So if you're expecting a continued increase in money supply because of excess, well, gold's the go-to. And now if you put on top of that huge geopolitical issues, right? You put on top of that war, which clearly you've got way too much of that, and the threat of a recession, again, not saying we're going to have one, but we're clearly towards the end of cycle. The fact of the matter is that there's recession risk. There always is, especially late cycle. So if we roll into one, gold's a top performer. Recap that, big money supply we think gets bigger out of necessity. We think that'll push gold prices up. Geopolitically, war tends to get worse and worse every day. So that's another catalyst for it. Thirdly, if we go into recession, we'd expect gold to perform as it has historically.
And what other assets are you looking at that have scarcity that you might allocate to?
Yeah, so commodities have scarcity, but so now we're talking about broad-based commodities. So let's talk about oil, copper, et cetera. So there's scarcity embedded within those, but there's also a lot of economic sensitivity. So with those assets, if the economy softens significantly from here, you'd expect those assets to pull back. But by and large, over the cycle, if we're right about this, where we're going to be in this continued big money error, eventually you think commodities are going to outperform, which we do. But I'd expect volatility between now and then. Another asset that we like, that we invest in our real asset solution, which really can go anywhere across these assets with scarcity, is in the real estate sector. Now, we don't love all segments of real estate, but there's a housing crisis here in the United States. We structurally underbuilt for an extended period of time. There's a shortage of housing. Now, there are investments you can make. We do on the public side, but you can also do it privately as well, where you're investing in multifamily housing, manufactured home communities, senior living facilities, and even places where you don't live, but there's scarcity embedded into it, which is self-storage. So that's the segment of real estate that we've been investing in, because there's a structural supply-demand mismatch that we don't think gets addressed shortly.
And one of the other asset classes, which is kind of new in modern terms, but is Bitcoin or digital assets. How do you look at that? And is that an asset you would consider in an inflation strategy?
We own Bitcoin in strategies that allow it. Now, here's the thing with Bitcoin. This is the way that we think about it. So let's just back up. We view Bitcoin as gold 2.0. Same scarcity benefits, but it's an improvement in many ways. It's easier to store, easier to transfer. So it's a digital enhancement to gold. We're excited about it. And now it's not either or for us, it's both. And we own a lot more gold than we do Bitcoin. For example, in our real assets solution, we're pretty close to 30% in gold, right? We've got a lot of gold. And where we can have digital assets, that number's a lot smaller. In our more aggressive strategies, maybe it's closer to 5%. In our more conservative or more balanced strategies, closer to 1 or 2%. So for us, the answer is not zero. It's some mix based off of risk tolerance, but we think gold's an absolute essential component of an asset allocation, absolute essential. And we think Bitcoin is as well. Betting against Bitcoin has been a massive losing proposition. People shouldn't feel so, it's funny, it's such a polarizing subject. And I feel like it's becoming less so over the years. But when I speak with investors, I still feel, and I polled an audience a couple weeks ago. I was speaking to a pretty big audience, and I asked people, who's open to Bitcoin? Not who loves it, who's open to it? And I got a large number of hands. And then I said, well, who hates it and wouldn't consider it? And then I got a large number of hands, and that bums me out. Why does it bum me out so much? You shouldn't be so emotionally attached to an asset. If I just called stocks asset 1, right, or asset A, called bonds asset B, right, gold asset C, and digital assets asset D, didn't tell you which ones they were, and I just showed you the returns, the correlations, right, all the risk statistics, you would be hard-pressed to leave digital assets off the table and out of your asset allocation mix. And we just want people to be open to this idea, because not investing in digital assets, specifically Bitcoin, has been a huge hindrance to outperformance. Huge hindrance. So you don't have to go all in. You don't have to own 10, 20, 30%, but it's hard to justify not owning 1 or 2%, because 1 or 2% is effectively a bad day of volatility in the S&P 500. Not a game changer, but given the asymmetric risk return profile, 1 or 2% can actually make a difference towards your long-term goals. So we are huge proponents of including Bitcoin in people's asset allocations. You
talked about risk tolerance, and in terms of your strategies in your portfolio, maybe you could talk a little bit about the process by which you determine allocations. I don't know if you just at a high level kind of help people think through. Now, you've talked about gold and Bitcoin and real estate and commodities. Let's say you've got these assets. How do you find the optimal mix?
Let's start with our universe. How do we get to our universe? Now, because we're on the subject of inflation, we're talking about real assets, we're talking about assets with scarcity, we do a lot of research figuring out, well, what are the right assets? What are the right assets to include in a mix to fight against these inflationary forces, to benefit from scarcity? Now, you could do a lot of research on that because you have periods of inflation. It's exactly what we did. So the first thing we did was say, well, fundamentally, what assets have scarcity? Let's list those out. Now, commodities clearly have scarcity. Gold clearly has scarcity. Real estate clearly has scarcity, so on and so forth. Now, find those assets with a fundamental reason, right, to have scarcity and for its value to go up when the currencies around it depreciate. The second threshold that we go for, that we don't always get, but the second threshold we go for is there historical precedence of outperformance during a previous inflation cycle? Now, the thing with inflation cycles, they don't come around often, but when they do come around, they last for a long period of time and they're pretty disruptive. So you go back to the 70s, well, how did gold do during periods of inflation? Awesome. Absolutely fantastic. Outperformed later in the cycle, which is a whole other subject we can get to if you want to. Commodities, great performance from commodities, and so on and so forth. Now, that's the ultimate litmus test. A fundamental reason to perform combined with the historical precedents. That's what we're going for. You're not always going to get the historical precedents. Well, Bitcoin wasn't available. That asset's about 15 years old. And we didn't have a major period of inflation since Bitcoin's been around prior to this one. So I don't have the historical precedents, but what I do have is a strong fundamental understanding that it should outperform because it's got this embedded scarcity. So that's effectively the way that we approach it. That's the first part. So now I know what I'm going to invest in because I know what the assets are with scarcity. Now I've got a whole other problem to solve for. And that whole other problem is, well, how do I weight them, right? How much gold do I own? How much commodities do I own? How much real estate do I own, et cetera, et cetera. For that, we put our risk hats on. We want to provide people with a well-diversified solution. So we break out our optimization. We say to ourselves, well, Mr. Optimizer, how do I run the most diversified portfolio? I run the most diversified portfolio by running an optimization that looks to maximize diversification by minimizing volatility. That gives me a really well-balanced portfolio because it's pulling on the diversification levers within the portfolio to give us a very, very stable mix. And then the last part is, you know what you're invested in, you know what the most diversified mix is, but is the most diversified mix the right mix for where we are right now, or should you go off that a little bit? Well, that's what we do. We go off that a little bit, meaning that commodities are a great diversifier. They historically perform well during periods of inflation, but commodity prices aren't doing all that well recently relative to other real assets. There's a lot of information in market pricing. So our understanding of when commodities perform, when they don't, and our quantitative measurement of the underperformance of commodity relative to the other real assets tells us that, you know what, now is probably not the right time to make a huge commodity bet. You probably want to allocate more of your assets to gold. Gold's a top performing asset right now. Over short, medium, and longer term windows, gold's a top performer. And gold is actually appreciating. Its price performance was strong after COVID. The bull market's accelerating. The market's clearly telling us something about the price of gold. Well, guess what? We're listening. We've got a lot of gold. We've had a lot of gold. We're going to continue to have a lot of gold unless things change. And then we'll reevaluate, revisit, and we'll make adjustments.
Let's see if I can recap what we talked about, David. Just inflation is still around. It may fluctuate. It may go down. We're in a period of a declining rate of inflation, but prices are still rising. But there might be periods where it bumps up again. But we are in an environment right now that speak particularly well to having an allocation to assets with scarcity. We talked a bit about gold, commodities, real estate, Bitcoin. Dave, did I roughly recap that correctly?
I think that you got that right. I would leave everybody with this really parting words of wisdom, if we can call it that. We laid out a lot of reasons why we believe that we were going to be in this period of structurally higher inflation. And again, we're not talking about extreme inflation. We're talking, let's call it 3 to 5. Tolerable, but higher inflation. If we're wrong about that, then your stocks do really well, right? Your bonds do well, right? And you're just fine. So if you allocate a portfolio, and let's just say you just have the minimal allocation that we would suggest, which would be 10% of real assets, or even 15 or 20%, well, guess what? 80 to 90% of your portfolio is going to do really, really well. But what if we're right? What if we're right and everything we've experienced continues for an extended period of time, and we feel really strongly that it will, but let's just say that we're right, and you don't invest, well, then what, right? Then what? So this is the whole point of diversification. You don't know exactly what's going to happen tomorrow, next week, next year. So why would you put your chips or your client chips all in on your financial forecasts? Don't. Just diversify. It's really that simple. It's not more complicated than that. 10 to 20% of real assets, lots of stocks, lots of bonds. Then, independent of what happens, you're all set. That's our message if you boil it down.
Fantastic. Dave, thank you very much for your insights and being on the show.
Ed, thanks so much. Loved it.
And thank you for tuning in to another episode of Trends with Benefits. To learn more about David and some of his insights, check out vaneck.com and you'll find a lot of his writings there. Thanks again. Take care.